Okay, so picture this. It's February 28, 2026. US and Israeli aircraft are hitting Iran. Oil markets are going absolutely haywire. Everyone's watching Brent crude. Everyone's watching the Strait of Hormuz. Everyone's doing the same read. And in Beijing, a completely different kind of alarm is going off. Because here's the thing that got buried under all the energy market coverage. The country most economically exposed to Iran's collapse wasn't somewhere in the Middle East. It wasn't in Europe. It was China, the world's largest oil importer. A country that has spent 15 years quietly building an entire economic architecture, a whole system of suppliers, financial plumbing, and geopolitical strategy on a single assumption, that Iran would always be there, always be sanctioned, and always be willing to sell oil cheap. That assumption is coming apart right now. And the consequences reach a lot further than the energy market. So let me walk you through exactly what China actually built on top of Iran, what's breaking, and honestly, this is the part one find most fascinating. Why the collapse of a country halfway around the world could end up affecting the price of things you buy every single week. Still with me? Okay, let's start at the foundation. Right, so for the last decade, Iran has been functioning as what I'd call China's off-the-books gas station. Because Iran is under heavy US sanctions, it has almost no buyers. And when you have almost no buyers, you drop your price. By 2025, Iran was selling crude to China at a discount of $8 to $12 per barrel below the international market rate. And look, on paper that sounds modest. But China was taking in roughly 1.4 million barrels of Iranian oil every single day. At that volume, that discount becomes a saving of between $4 and $5 billion per year. $4 to $5 billion. Not a rounding error. A structural subsidy hidden inside Chinese industry's balance sheet, invisible to the outside world, but completely real to every factory burning that fuel. Now, and this is the part people miss, that oil wasn't flowing through normal channels. What China built is, how do I put this? It's less of a trade relationship and more of an elaborate magic trick. A fleet of roughly 1,337 tankers, as of early 2026, operating by turning off their GPS transponders, transferring oil between ships in the open ocean off the coasts of Malaysia and Oman, and then falsifying the paperwork to say the cargo came from somewhere that wasn't Iran. Chinese customs officially recorded zero Iranian imports for years. Satellite tracking showed over 1.4 million barrels arriving daily. The U.S. sanctioned more than 875 vessels tied to this network in 2025 alone. The fleet just changed the ships' names, changed the flags, and started again. I know, it sounds like a film plot. It isn't. And that oil wasn't just keeping the lights on. It was the economic oxygen for an entire tier of Chinese industry. In China's Shandong province, a coastal industrial region, roughly the size of Wyoming, if you want a frame of reference, there are several hundred small, independently owned oil refineries. The industry calls them teapot refineries. That nickname sounds almost charming. The reality is not. These facilities account for about 1/4 of China's total refining capacity. 1 in every 4 barrels of oil refined in China passes through operations that are structurally dependent on discounted, sanctioned crude to stay profitable. Their entire business model is built on that price gap. When the gap closes, their margins collapse. And right now, with the conflict escalating and the ghost fleet increasingly exposed, that gap is closing. Okay, stay with me, because this next piece changes the whole picture. The energy dependency is only the first layer, and actually is not even the most strategically important one. Here's the number I want you to hold on to. In March 2021, China and Iran signed a 25-year agreement, what they call the Comprehensive Strategic Partnership, in which China pledged a staggering $400 billion in investment into Iranian infrastructure. Ports, railways, telecommunications, energy development. $400 billion. To put that in perspective, that's larger than the entire GDP of South Africa. That is not a trade deal. That is a civilizational bet. And woven through that agreement was a geographic reality that most Western analysts have consistently underestimated. China's flagship foreign policy project, the Belt and Road Initiative, which is essentially a modern Silk Road connecting Chinese manufacturing to consumers in Europe, Central Asia, and Africa, has one critical physical bottleneck: Iran. For the land-based corridor to function, cargo has to move through Iranian territory. Iran's Chabahar port serves as the gateway to landlocked Afghanistan, Central Asia, the southern reaches of Russia. If Iran becomes unstable, actually, wait, let me reframe that. It's not just instability that's the problem. It's what happens to the investment. When the infrastructure it depends on goes offline, the railways go nowhere, the ports handle no cargo. Hundreds of billions in Chinese investment becomes, as analysts in Beijing have privately acknowledged, broken tracks and scrap metal. If you're sitting in a room in Beijing right now with all of this on the table, what do? You've bet $400 billion on a partner that just got hit by the most significant military operation in the region in decades. Do you double down? Or do you start calculating the losses? And here's the thing. China knew this risk existed. It accepted it anyway. Because Iran was also providing something that's genuinely harder to replace than cheap oil. Strategic cover. For years, Iran's aggressive posture in the Middle East, the nuclear program, the proxy networks, the constant regional tension, absorbed enormous amounts of U.S. military attention and diplomatic resources. While Washington was managing Tehran's nuclear brinkmanship, it had fewer resources to focus on what China was doing in the South China Sea, or around Taiwan, or across the Indo-Pacific more broadly. Iran, in a very deliberate sense, was a distraction that Beijing found deeply useful. That distraction is gone. Operation Epic Fury struck Iran's nuclear infrastructure and its military-industrial backbone. Iran's capacity for nuclear brinkmanship was sharply degraded. And when Tehran came under sustained attack, none of its strategic partners, not China, not Russia, not North Korea, intervened in any meaningful way. The anti-US bloc that Beijing had spent years building was exposed in a single operation, as a paper alliance. Think about what that means going forward. The U.S. military, no longer pinned down managing Iranian escalation cycles, can redirect attention toward exactly the theater China fears most: the Indo-Pacific, the Taiwan Strait, the South China Sea. For China, Iran's collapse isn't just an energy problem, it's a security problem. And then there's the fourth layer, the one that operates furthest below the surface, but whose collapse carries the longest-lasting consequences. Okay, there's one concept here that you really need. And once you have it, everything else in the story clicks into place. It's what's called the Petro-Yuan. For the last several years, China has been quietly building an alternative to the dollar-based global financial system by settling oil transactions in Chinese currency instead of US dollars. Now, I know what you're thinking. Okay, why does that matter to me? And that's actually the right question. Because the US dollar's role in global oil trade isn't just a financial convention. It's the foundation of American financial power. When the U.S. wants to pressure a country, Iran, Russia, Venezuela, it does so primarily through the dollar system, cut off access to the global banking network, make it impossible to conduct dollar-denominated transactions. For China, which faces that exact threat in any future confrontation with the United States, building an alternative plumbing system it's not optional, it's existential. Iran was the perfect testing ground, already excluded from the global banking network, already unable to use dollars. Iran had no choice but to settle in yuan. Every barrel purchased in Chinese currency was another data point, proving the Petro-Yuan could work at scale. By early 2026, China was buying roughly 90% of Iran's total oil exports and settling most of those transactions in yuan. Iran wasn't just an energy supplier, it was the primary laboratory for China's most important long-term financial project. And if Iran collapses, China loses its lab. So here's where we are right now. And honestly, this is the part that surprised me when I first looked closely at the numbers. Since the strikes began on February 28th, Brent crude surged from around $70 to over $110 per barrel within days. The Strait of Hormuz, a shipping lane so narrow that the navigable channel is only 6 kilometers wide, became a zone of active military tension. And here's the thing about blockades that most people don't realize. You don't actually need a physical blockade to stop oil flowing. Insurance companies pulled war risk coverage almost immediately, and shipping insurance premiums jumped 5-fold in 48 hours. Without insurance, tankers can't enter ports. Tanker traffic dropped sharply. You could almost hear the entire supply chain locking up at once. China's teapot refineries, remember that phrase from earlier, saw their operating costs jump in real time. South Korea's stock index suffered its worst single-day crash since the 2008 financial crisis, dropping 12% and triggering an automatic trading halt. Sri Lanka reintroduced wartime fuel rationing. Bangladesh capped daily fuel purchases per vehicle. And this is just the immediate picture. In the medium term, China will adapt. Of course it will. It's already ramping up Russian oil purchases. But Russian pipelines only cover about 6% of China's total demand, and significantly expanding that would take years of infrastructure investment. China's strategic petroleum reserves, estimated to cover 75 to 110 days of consumption, provide a buffer, but not a solution. You know that feeling when your phone hits 1% and you're nowhere near a charger? That's approximately the strategic position China is in right now with its energy reserves. Functional for the moment, deeply uncomfortable for what comes next. And here's the deepest irony in all of this. The collapse of Iran actually vindicates the entire logic of U.S. sanctions policy. For years, critics argued the sanctions weren't working, that the ghost fleet proved they were porous, that China's continued purchases made them meaningless. And in a narrow technical sense, that was true. The oil kept flowing. But the sanctions worked at a slower, more structural level. They kept Iran dependent. They kept Iran unable to develop into a stable, reliable partner. They created conditions in which Iran's system became too fragile to survive a direct confrontation. The vulnerability was never in the oil trade. The vulnerability was in Iran itself. China built a $400 billion strategic architecture on a foundation made of sand. Okay, last thing, and I want you to actually sit with this one before you move on to whatever's next. Whether a post-conflict Iran moves toward a more Western-aligned posture or fractures into prolonged internal instability will determine whether those Belt and Road investments are recoverable or permanently stranded. And whether China can build sufficient alternative energy infrastructure fast enough will determine how much pain those teapot refineries absorb and how much of that pain flows through to the price of goods on shelves around the world. This whole story was really about one thing. Not oil, not even money. It was about what happens when you build the foundations of the world's second-largest economy on top of someone else's survival. And the question I keep coming back to, the one I genuinely don't have an answer to, is this. Beijing knew Iran was fragile. It knew the ghost fleet could be exposed. It knew the whole architecture rested on a sanctioned, isolated regime. So the real question isn't what happens to China now that Iran is collapsing. The real question is whether China ever actually believed this bet would hold, or whether it always knew it was buying time.